Hello, everyone, and welcome to the Triumph Capital Management, the Biden tax plan. Today will be short and sweet, but we're going to run through the six major key points of the Biden tax plan, and I will take time to unpack all of these things for you so that they make sense. Before we start, I'll talk about a few disclosures. Triumph Capital is an independent firm, which means we work on behalf of our clients. We're a registered investment advisor with the Securities and Exchange Commission. This presentation is not really designed to be a solicitation of any type of service or a solicitation of any type of recommendation or security. It's really for educational purposes. The presentation does make forward-looking statements about the government's or Biden's tax plan, and such statements may not be already written into law. Obviously, we urge you to seek professional advice on any of the topics that we'll be covering. All of you will receive this recording, and all of you also have this presentation available for download in your handouts. Tomorrow, you'll receive an email that will be a recording of the presentation. Because you will receive this, I'll skip about the speaker. But there are six major points that we'll cover today. The first thing is the increase in the top tax brackets from where they are today up to 39.6%. We'll also discuss Social Security taxes and how they will double for income earners over $400,000. We'll discuss the estate tax issues. Estate taxes going from where they are today at 40% up to 45%. As well as reducing the amount of money that is subject to estate taxes, not the amount of tax money that's subject to estate taxes, but the amount of money that one can pass away with and avoid estate taxes. We'll talk about the elimination of the preferential tax rates on qualified dividends as well as long-term capital gains. And we'll also talk about the elimination of the step-up in basis, which is a really big one and affects everybody. So let's start to unpack these six different key points. The first thing is individual and corporate tax rates. Okay, so how will the Biden tax proposal affect individual and corporate tax rates? Well, just to give everybody a refresher, here's the way in which tax rates work today inside of the United States. What you're looking at on your screen is a married couple who files jointly. The way in which this works is you make all this money, right? And then you have all these deductions and everything else, and then you're left with a pile of money that you made. Well, the way that it works is on your first $19,900, that $19,900 of taxable income is subject to a 10% federal tax. And so on a married couple's first $19,900, they're going to pay $1,990 to the federal government, or 10%. The next bracket is the money that's earned between $19,901 up to $81,000. The delta, the difference between those two numbers, is just about $61,000. In other words, that $61,000 is then taxed at 12%. That continues to go up these brackets, okay? And then you get to any income for a married couple that's earned over $628,000, it's taxed at this 37% rate. So I say to people all the time, everybody pays the same amount in taxes, at least from a percentage standpoint. Me, you, Warren Buffett. In this instance, if you're married filing jointly, you and your spouse and Warren Buffett and his spouse pay the same 10% on their first $19,900 of income. It just so happens that Warren Buffett has a large amount of income over $628,000, him and his wife, and all of that income's taxed at 37%. This is the way in which it exists today. Now, in Biden's tax proposal, what is being proposed is that income over $400,000 be taxed at 39.6%. So what you can see here on the screen is the married filing jointly brackets again. But what I've done here is I've highlighted in red where the brackets are today. So you can see 32, 35, and 37. And you can see all of those going up to 39.6% for income earners over 400,000. Okay. So taxes going up. This is a married filing jointly. And in 2017, there's been a long debate for 20 plus years about the corporate tax rate in the United States of America. It's always been one of the highest around the globe. And in 2017, that corporate tax rate went from 28% down to 21%. Inside of the Biden tax proposal, it'll take that corporate tax rate from 21% back up to 28%. There was a lot of folks that in 2017, 19, 18, 19, and even here in 20 worked with their CPAs and that type of thing to maybe reorganize their corporation from an LLC or an S Corp to a C Corp. Why? Because the tax rate went from 28 to 21. However, some may need to rethink that. So in summary, remember, we're going to unpack 6 different issues here. But in the first issue, we just unpacked it. It was the increase of the tax brackets up to that 39.6 on income above 400,000 and the corporate tax rate. So in summary, the Biden tax plan would repeal the major tax reductions passed in 17. It would increase the top individual federal income tax rate from 37% to the pre-Trump rate of 39.6% and increase corporate tax rates from 21 to 28. Next, for individuals with incomes over $400,000 or more, the tax benefit afforded itemized deductions are capped at 28%. So even though you might go and be receiving a whole bunch of deductions, it's going to cap you at the 28% of your total income, rather than how it is today. You could just able to take deductions. And then again, tax rates would be graduated so that individual taxpayers with incomes below 400,000, again, this is a married couple, would not see rate increases, but money above 400,000 would go up quite substantially. So let's go on to point number 2, Social Security tax. Similar to the individual tax rate, the Biden proposal would increase Social Security taxes by imposing taxes on earnings over $400,000. Don't worry, I'm going to unpack this for you. Currently, Social Security taxes are 6.2% and are against wages. If you're earning a wage today, of $142,800. Don't worry, I'll unpack that as well. It's not very well understood. For many of you that have been in the office, I've explained how this works, but I'm going to unpack it on the next screen here. The proposal creates a caveat where Social Security taxes would stop on income over the normal threshold of $142,000 in 2001, and then apply to amounts above $400,000. This increase would apply at the employee-only level, and it would be at a rate of 12.4%. Let me unpack this for you, okay? So here's what happens. If you work for a company today, or heck, even if you work for yourself, okay? But for an example, let's just say I have a client and that client works at Google and they're an engineer at Google and they make $250,000 a year. That's their salary from Google. Well, when they get paid, as you know, from their paycheck, taxes are already withheld. One of those taxes is Social Security taxes, okay? What happens is 6.2% is withheld for Social Security. However, remember, my employee works at Google and makes $250,000. What happens whenever you hear the politicians debating about Social Security? Is it still going to be around? Is it going to be viable? And so on and so forth. Here's what a lot of people don't understand. That employee who works at Google making $250,000 a year, They stop paying Social Security taxes on every dollar over $142,800 in 2001. In other words, somebody making $1 million gets a raise on every dollar that they make over $142,800 because they no longer pay the 6.2% Social Security tax. It's only taxed on, the first 142 grand that you make. Okay. What happens, however, is the employer, in my example here, Google being the employer, if they're paying that employee 250 grand, the employer they're still paying the 6.2% on the full 250. Okay. Under the Biden tax plan, here's what would happen. Okay. Again, 2001. So you can see these are the numbers from yesteryear. Under the Biden tax plan, it would still be at that $142,800 number. In other words, you would pay Social Security taxes on wages up to this number at 6.2%. Then you would pay no Social Security taxes on the money that's earned between $400,000 to $142,000. But every dollar that one makes over $400,000 would then be taxed at a whopping 12.4% in Social Security taxes. So this is what's on the Biden proposal, okay, for Social Security. So again, summary of the Social Security taxes. It would apply to everything would remain the same. But if you make over $400 grand a year in a salary, every dollar earned over $400,000 would be taxed at a whopping 12.8%. Again, current Social Security taxes imposed on employment wages up to 142 grand, so nothing changing there. But again, there's the caveat, right, above 400 grand at that whopping 12.4%. These are, we're going to switch gears. We'll go on to point number 3. We're going to start talking about estate taxes and gifts and that type of thing. And this is confusing for a lot of people, but this will affect everybody when I get to the step up in basis. You want to pay particular attention here because it'll affect everybody who's inside of the meeting today. Okay, so let's walk into it. Here's what happens. People are confused about this. You hear about it explained on TV as the death tax, estate tax, so on and so forth. Well, let me just unpack it, okay? Currently, individuals can pass away with $11.7 million of an estate value, okay? Every dollar that your estate's worth over $11.7 million is then taxed at a 40% rate. So let me explain that, okay? Say you have a single person. I'll get into a married couple in a second here, but say you have a single person, and that person passes away in 2021. What happens is you look at their entire estate, everything that they own, their home, vacation home, cufflinks, cars, retirement accounts, bank accounts, investment accounts. The list goes on and on and on and on and on. And then you add that all up, and all of a sudden, if all of that comes and it's worth more than $11.7 million on that individual, every dollar over that is taxed at 40% by the federal government. By the way, I get the question all the time, hey, isn't my life insurance excluded from that? It is not. If you have a life insurance policy for $5 million and you own it as an individual or jointly with your spouse and you pass away and that $5 million is then paid to beneficiaries, that's included in your estate, okay? Under the Biden tax proposal, what it would do is it would shoot it back to the 2009 levels, which was $3.5 million. Okay, so it would go from 11.7, it doesn't affect many people today, all the way down to 3.5 at the individual level. Okay. And sometimes people say, hey, that really won't affect me. But you, believe it or not, you start looking at it. Maybe you do own some life insurance or something like that, because life insurance is a big cash influx. And all of a sudden, you're over 3.5 million. Also, instead of the government getting 40%, the the government would actually get 45%. We're going to dig more into this in a little bit, and I'll show you where it starts to affect everybody, okay? But let's keep working here. As far as unpacking it, so currently individuals have that $11.7 million. But a lot of folks are married today. So a husband and wife can pass away with $23.4 million, which is really the 11.7 times 2. So in other words, you got a couple, husband and wife. Husband passes away. He's married. When the husband passes away, the wife inherits everything. Let's say the husband's got $100 million. There's no taxes to the wife, okay? And vice versa. There's no taxes until it crosses the marital line. The wife can't live without the husband. She passes away a day or a week later, and the entire estate's now worth $100 million, and they got one kid. The one kid is me. They've done no estate planning. Well, what would happen is $23.4 million would come to me completely tax-free, and then the other $77 million would then be taxable at the federal level at 40%. That's how it works today. Under the Biden proposal, it would work the same way. Everything that I said, except for the number would shoot down to $3.5 million. Again, for a married couple, it'd be double $7 million. Okay, but the tax rate would increase to 45%. Okay, so we'll keep going here. But Biden's proposal could affect tax-free transfers of property on death in two ways. Under the current law, the 11.7 is not taxed times 2 for a married couple, okay? And Biden's plan would reduce it to 3.5, back to the 2009. The potential changes could create all kinds of different estate taxes and other tax issues for beneficiaries, especially for those of us on the call who own businesses. But we'll keep working here, and I'm going to come back to the estate side on what this thing called a step-up in basis. Again, it will affect everybody on the call, okay? If we go on to one of the next points, point number 5, is to eliminate certain tax rates. So let me explain, okay? So today, this is that same tax chart that I showed you a few slides ago. Again, on your first 19 grand, taxed at 10%, then the money that's earned between 19 and 81, which is about 61 grand, taxed at 12%. There's that 628,000 Warren Buffett, that whole story. So this tax bracket right here that I'm circling with my pointer, that applies to earned income. Okay, so if you're working at a job, you're self-employed, you're taking income in, if you have interest, okay, that's earned inside of a bank account, or income from bonds and that type of thing, it's all taxed at these rates, right? However, you then have capital gains and dividends. These are called these are the pref rates. Okay, so let's just say you go to work someplace, you make again 250 grand a year at Google. That, and you're married individual. Say your wife works there too. You make $500,000 between you and your wife. You're both engineers there. That $500,000 is going to work its way through this tax bracket. But you then have an investment account, a regular investment account, not a retirement account. And inside of that regular investment account, inside of that regular in that account, it's producing dividends, it's producing interest, it's producing capital gains. Capital gains is, quite frankly, just when you buy something and then you sell something, and when you go to sell it, you sell it at a gain. The way that our capital gains and dividends work today is they're not taxed up here. They're taxed down here. So what it says is, hey, look, if your income is $0 to $81,000, you actually pay no income taxes on dividends. You pay no income taxes on capital gains. This was changed under the Obama administration. It used to be, hey, everyone just paid 15%. If your income's between $80,000 and $500,000, you pay 15, okay? And then if your income is over $500,000, you pay 20% on capital gains and dividends. And so under the Biden tax plan, what would happen is there'd be some elimination of these preferential tax rates. The Biden plan will tax long-term capital gains and qualified dividends at the new top ordinary income tax rate of 39.6% if your income's over $1 million. This was always a big discussion, right? And the reason why it was a big discussion is because double taxation without double representation. Let's keep working here. So we talked, we've worked through a lot of the different key points, but here's a big one. This is the biggest one. It's why I kind of saved it for last. And it's the elimination of the step up in basis. So the Biden plan has proposed to eliminate the step up in basis for inherited capital assets. Therefore, the beneficiary would either assume the decedent's cost basis in the asset, or the unrealized capital appreciation could be taxed at the decedent's death. What in the world does all of that mean? Let me explain, okay? The best way for me to explain this is this, and it kind of goes back to the whole estate plan. And people say, hey, maybe their folks are still alive, or whatever. They're worried about passing assets on to their kids, or whatever the case may be. Hey, look, I understand estate taxes. Let's say the Biden plan brings it down to $3.5 million. My folks are married. Therefore, if they pass away and the Biden plan brings it down to 3.5, when they pass away, dad goes first, mom goes second, $7 million gets the transfer, okay, without estate taxes. Who pays the estate taxes? Mom does. In the year in which she died, okay, think about it. Some of you on the call have worked through this. You have a relative who passed away you've been the executor on. Well, estate taxes, okay, get paid by mom. She files a tax return in the year in which she passed away. And then what happens is the executor of the state goes, oh, hey, look, you had estate taxes. You died with $9 million. We owe, whatever, $1 million to the government, or, $800,000 to the government in this instance, and then they pass on the heirs to the relatives, okay, or they pass on the rest of the assets to the heirs, okay. So what is an elimination step up in basis? Let's say, for instance, you go, well, my folks, or when I go, I'm not worth that amount of money. We have nothing to worry about here. So let's use the house as an example. One, or a stock, for example. It doesn't make a difference. Any capital asset. So mom or dad or whoever bought the stock or the home, let's say in 1985, and they paid $100,000 for it. I don't know if it was the house or Apple stock. Doesn't matter. Any capital asset. Today it's worth $1 million. No estate tax issues. That's a separate issue. Okay. So let's remove that for a second. Mom passes away. I inherit the home. That or the stock. She paid $100,000 for the stock in 1985. It's now worth $1 million. I inherit it as the sole heir. Well, what happens is on the date of death, I get a step up in basis. That stock that's now worth $1 million, it's as if on the date of her death, I bought the stock for $1 million. Let's say I sell it the next day for $1,001,000. How much do I owe taxes on? Only $1,000. What if mom sold it while she was alive? Remember, she only paid $100,000 for it. It's worth $1 million. So if she sold it while she was alive, she would owe taxes on that $900,000 gain. But when she passed away and she left it to her heirs, me in this instance here, got a step up in basis. So again, I inherited it at $1 million. What if the next day the stock or the asset falls and now it's only worth $950,000 and I sell it? I actually get a loss. I lost $50,000 because again, it's as if I bought it for $1 million. So eliminate the step up in basis. What that means is that the beneficiary would either assume the decedents, the person who's passed away's cost basis. In other words, the whole storyline I just gave you, I could still inherit the stock, but it's as if I inherit the cost basis with I paid $100,000 for it back in '85, or the unrealized appreciation will be taxable at the decedent's death. Again, this is what affects everybody on the call today. This has nothing to do with the estate taxes. Estate taxes is a separate issue, right? Estate taxes just goes, hey, if you're worth this big, huge pile of money, government's going to come in and they're going to grab it. Then you still have all the ordinary taxes to deal with, right? You know, it's just, hey, does the estate tax affect me? If it doesn't, you still got a bunch of tax issues to deal with, and this is a huge one, the step up in basis. It's been around forever. So I'll unpack it a little bit more, okay? So estate taxes or death taxes, they're one and the same. Today it's $11.7 million if it's married, times it by 2. The tax is on the estate of the decedent. Again, mom files a final tax return in the year of her death. Under the Biden tax plan, this is going back to $3.5 million. Again, married $7 million, and the rate goes from 40 to 45. By the way, retirement accounts are still taxed. So in other words, you got a married couple, mom passed away, dad inherits all the money, they're worth $10 million, right? Dad passes away, the government comes in and goes, hey, look, you could only die with $3 million's taxable to us. We're going to get 40% of it. So you know the executor writes a check out to the government for the $1.3 million, and then what's left in the estate goes down to the heirs. Well, let's say part of that estate calculation, those retirement accounts, I don't know, let's say $3 million was in an IRA, and say I'm the guy who's inherited from my father who just passed away. I just paid the 1.3 in estate taxes, right? I got all the rest of the money. Hey, fantastic. But again, $3 million of it was in retirement accounts. When I go to draw out the money from the retirement account, I still got to pay taxes on it, just as when Dad was alive and he was drawing money out of the retirement account, he had to pay taxes on it. Again, the big deal in a lot of this is the step up in basis exclusion. If you have a step up in basis issue, even if you're below the estate tax limit, it's not like, hey, well, I paid estate taxes, so I don't have to worry about the rest of the stuff. Gifting. So what in the world, people are like, people get this confused on gifting. So let me just explain this, right? Because this is also changing in the Biden tax plan. Okay. So what happens today in 2021? You can give $15,000 to as many people as you want to. Literally, you can stand out here with your checkbook on the 16th Street Mall, and every stranger who walks by, you say to them, hey, I'm going to write you a check for $15,000, right? So why in the world do people gift? I get this question all the time. Well, the reason why people gift is it's a way to help keep their estate value in check. In other words, you look at it today and you go, you know what, myself and my wife, $3.5 million, $7 million, heck, our kids are going to get this anyways. And our net worth continues to grow, right? So what the government said is, hey, you know what, you can gift $15,000 to as many people as you like. So typically speaking, a husband and wife would say, look, we got 3 kids. I'm going to give kid number 1 $15,000. My wife's going to give kid number 1 $15,000. $30,000 went to kid number 1. $30,000 to kid number 2. $30,000 to kid number 3. They just took $90,000, right? At the end of the year, they make the gifts, and the $90,000 is just a way to help keep their estate, value, not from blowing up too much. Now, it's not a lot you can gift, right? That's why people do gifting, okay? What happens if you gift over $15,000? People always ask me that. They're like, "What? If I gift more than $15,000, I have to pay taxes on it. What happens?" No. Today, you could gift somebody. You could write, if you had the net worth, you could gift somebody $10 million. Okay, that person doesn't owe taxes on it. But for every dollar you gift over $15,000, it eats into that $11.7 million. In other words, today, let's say I'm worth $100 million, and I write a gift for $11.7 million, right? Because my kid's going to get it anyways. When I die, I've already used my gift exclusion. Does that make sense? Okay. Now, here's the big thing under the Biden plan. You'll still be able to gift the 15 grand, okay? The exclusion goes to 3.5 million. But here's the big deal. The maximum gift per year will be reduced from where it is today at that 11.7. It'll go down to 1 million. You won't be able to give, right? So it'll take you long. Like there's estate strategies where you can gift money to a irrevocable trust and that type of thing, and then it's not part of your estate. We do that type of planning all the time for folks. Okay. But it's going to become harder not to do the planning, but harder to move money out of a taxable estate. How can we help? I think you all know this stuff, but just to kind of point a few things out, there's different types of tax deferral programs, and when using these different types of programs, you can actually control when that income is recognized, right? Because tax plans will change and that type of thing. Tax efficient gifting and trust strategies. For many of you on the call, one thing that we do is an awful lot of estate planning, and inside of that estate planning, should it call for it, we come up with these wonderful creative plans to get money out of the estate that you still control, so on and so forth. And obviously, as an independent firm, we have a wide and deep of investment options to help our clients with. Join future educational webinars. For a lot of you on the call, we did, in years past, a lot of dinners, educational type of stuff. We haven't done that stuff in a long time. A lot of that came from the coronavirus, so on and so forth. But if you visit our webpage, which is just www.triumphcapitalmanagement.com, you'll see an events tab. On the screen, you can see a URL, and that'll bring you right to the events tab. But you'll see it. This is the home page. You'll see the events tab. We have different events. We're going to be doing them a lot more often. On these type of presentations, we have a lot of folks on the call, so we don't like to open up the lines for questions and that type of thing. But if you'd like to set up a time to talk, again, you'll all have this presentation. You all have this as a download, and you'll all receive this tomorrow. You can click on either one of these buttons and schedule a call or a go-to-meeting. Also, if you were on our webpage, if you dance around and you go to About Us and you find me, at the bottom of my profile there, you have these same two links where you can schedule. So anyhow, until next time, thank you from Triumph Capital Management. We hope you enjoyed the presentation, and we hope you learned something about the Biden tax proposal. Again, increasing top tax brackets, Social Security wages going to an amazing 12.4% on income above $400,000. State taxes going from, an individual 11.7 down to 3.5 and taxed at 45% as opposed to 40. Gifting, how that all works and why people gift, and then also how gifting will change under the Biden tax proposal. Long-term capital gains and dividends, that will only affect folks, that number will go way up to 39.6. That was really a shot at a lot of hedge funds and that type of thing. But if income's over $1 million, now those dividends and long-term capital gains are going to get taxed at almost 40%. By the way, all the numbers that I showed you today are federal numbers. Depending upon what state you live in, there's also state tax that lays on top of those numbers. I was watching the TV here the other night, and they were showing, hey, if you live in New York, you're going to be paying like 56%. The last piece is the step up in basis. Again, it'll affect everybody. Everybody, if they inherit any asset or plan to leave any asset to heirs. All those wonderful step-ups that occurred, it's on the table that they'll be taken off. By the way, I guess the last thing I'll say is people say, hey, Derek, when is this all going to take place? We don't think really any of this will really start to take place until 2022. I think any major tax reform could be passed in 2021. We think that this will all be packaged inside of the infrastructure bill that the Biden administration is currently working on. So it's not going to come out like, hey, this is just a tax bill. It's going to be pushed into the infrastructure bill. Of course, everything I showed you here was what the Biden tax proposal is. There'll be probably some push and some pull and some modifications to these numbers, but I think you can see inside of here the picture's quite clear as to where this is going. By the way, if you're like, hey, Derek, that's all great, what in the world am I going to do about it? There's a million different strategies and there's a different million things you can do about all of this stuff to still, ensure assets are passed to your loved ones, or if you're expecting to receive assets that, the planning is done. Nobody, plans to fail, but people do fail to plan. So please, if you have issues, if you have concerns, if you have questions, please reach out to us. We would love to talk to you. Again, thank you so much. We hustled through this. We're going to be done at 4, so I'm 7 minutes shy, and we covered a lot of territory with 6 different talking points there. Thank you all. We hope to see you on future educational presentations. We have one coming up, I think, next week on 2021 tax strategies, things you can do with your assets to be smart tax-wise and investment-wise, followed by the middle of April or the beginning of April, the state of the markets. But many of you like the state of the markets. We'll bring you through what happened in 2020 and then bring you up to speed on Q1 2021. Again, you can register for all of those things at the Triumph Capital website on the events tab. Again, thank you all and have a wonderful evening. Okay, signing off. Bye-bye.